Yeah, a very solid quarter, both operationally and financially for us, right across all of our business. We saw record volumes and results on the liquids business. Our mainline pipeline system saw record volumes. Our export facilities saw record volumes, and so we beat obviously the street estimates for the quarter, which is great, and reconfirmed that we would meet our goals for the full year. And we announced a little bit of tuck-in M&A. We bought some renewable offshore wind facilities that we had originally participated in Germany, and then renewable natural gas facilities in the United States. All very long-term contracts, 10 years or more, and all very consistent with that, all of the above approach that I think the public want, that investors want, and that actually creates a lot of value for us. So we're pretty excited about the road ahead.
Why is, the stock's up today, but why
Yep.
is it down 13% year to date? Is it the underlying commodity that's a problem? Is it concern about demand? What's holding the stock down?
You know what? We have been, and very proudly so for decades, increased the dividend year after year, very utility-like in that structure. And as you guys pointed off just a few minutes ago, with interest rates that have been up, that impacts dividend-paying stocks like ourselves. And as you've seen in the last, call it 4 days, what we've seen 40, 50, 60 basis points coming in on the 10-year, you've seen the stocks that pay dividends react. So it's not the commodity, it's not energy demand. We see up those. We don't have commodity exposure. Really is that 10-year interest rate side of things. So that's a macro factor that, frankly, I can't do anything about. What we can do is make sure the company runs well, meets its earnings targets, and continues to build up both organic growth and some of these acquisitions.
Greg, talk to us about, again, you mentioned some of these acquisitions and the investments you make in renewables. Realistically, do you have a good handle on the types of returns you can get on renewables? It just feels like maybe some of the shine is off that side of the energy business.
Well, it's a good point. I think investors are starting to figure out that renewables are all not built the same, right? So those that have long-term contracts, in other words, 10, 15-year contracts with great counterparties, so larger utilities or big industrials, those are the ones you want to participate in because, they've got a guaranteed price set on that power. They've got a great investment grade customer that's taking that power, and you're going to get paid. Those that are kind of going in a merchant world and haven't got these things contracted, or in jurisdictions where it's extremely difficult to build things, which is a lot of jurisdictions these days, I think you're seeing those entities being, a lot tougher to get the returns that the ones I previously talked about, which is why our renewable business, which we've actually been in for 20 years, is all about that contracted business. So our European stuff, our customers are folks like EDF, Electricité de France, or the government in Germany. And then here in the US, most of our customers would be utility-like players. And even on the renewable natural gas tuck-in that we had today, we have 10-year contracts with the likes of BP and Shell. So I think, and I think this is great for companies like Enbridge who have done it on a low risk basis, that you're going to see differentiation. Those that have actually structured their businesses to create good returns, double digit returns, are going to be rewarded, while those that have gone more merchanty, I think that's going to be a tough slug for them.
Where do you see demand going for energy? I mean, as we see the jobs numbers miss, and as we expect either a soft landing or a recession, I imagine demand slows down. Is that the case?
Yeah, typically energy is about two-thirds of GDP. In other words, energy growth grows about two-thirds of GDP. So if you thought GDP was going to be 3%, you get energy at 2. That's one. Two, remember, people don't shut off their lights and they don't turn off the gas in their house, even when you're in a recession. Where you see it is on some of the industrial load, but most of our stuff is for ultimately residential players. So I don't see that has any big impact. But remember, we're building assets for 10, 20 years. So virtually every report that you would see globally and in the United States, we will be using more energy 10 years from now than we use today. And particularly so in developing countries, you're going to see them continue to move up the economic food chain, and that always requires more energy. So some of our assets on the export side of things, whether it's our liquefied natural gas export facilities we're building on the west coast of Canada, or our oil export facility on the Gulf Coast of the United States, which is the largest in the US, you continue to see very good response there, even through recession. So, yeah, I think the demand comes down a bit, but it continues to grow.
So I saw you announce intentions to buy some utilities, I guess in Ohio, North Carolina, and Utah. I mean, it's a big number, $14 billion. What's the strategy in the utility business?
So it's interesting, maybe a little bit of contrarian, but I think we're right on this. We've been in the utility business for a long time. We've got the largest gas utility in Canada. This will make us the largest gas utility in North America by volume, serving some 7 million customers in jurisdictions that are really gas friendly. So they actually have ban legislation, if you will. They will not allow communities to ban natural gas. They know how important it is for industrial growth. Think of what's going on in Ohio, so much from a steel, automotive, refining perspective. Gas is critical. And then growth areas like North Carolina and Utah, very favorable environments. So we saw that, and it fits right into our dividend paying, low risk environment. And gas continues to grow. In fact, these utilities, you will see their rate base, or if you will, their customer setup and the assets that they use grow by a compound annual growth rate of 8% through the end of the decade. So that was our strategy. We had a seller that was largely an electric player that had to move out of that business for other reasons related to its electricity business. That created an opportunity. We were able to buy that as historic lows, 1.3 times that base of the business. So we're a big enough player we could buy all three, and that's really exciting for us as we move and close those in 2024 and have them fully in the barn and ready to produce in 2025.
So I'm looking on the Bloomberg terminal, Greg, and I see a dividend yield for you guys of 7.6%. I mean, that is just huge. What's a dividend policy you kind of communicate to your shareholders?
Sure. So we pay out, and we've been paying a dividend for forever, and it's an important part of our equation. I think our compound annual total shareholder return is about 11% since 2000, and you go back to the 60s and you'd find it about a similar number. And the philosophy there is, as we build these low risk projects and we bring them in, we can pay out 60 to 70% of that cash flow to investors through dividends. And so the higher yield right now is really driven by, as we talked about, the 10-year yield having an impact on that. People will put their money in U.S. Treasuries versus some dividend-paying stocks. So I would expect that to come down, the stock to go up as you see some softening on the yield side of things. But that 60 to 70% payout, very comfortable for us, very much in line with our cash flow, and allows us to retain enough cash to continue to invest in the business.